Well, good afternoon. Happy Friday, September 24th. Mark Milam here with Highland Mortgage, your mortgage professional, with this week's interest rate summary and market update. All eyes this week on the Fed, right? This was our regularly scheduled two-day meeting, Tuesday and Wednesday, with the policy statement coming 2 p.m. on Wednesday, and really no significant surprises from the Fed. We heard them. They're going to keep the Fed funds rate exactly where it is, and they're starting to contemplate tapering their mortgage-backed securities purchase program and the treasuries, but we really are focused on is the mortgage-backed securities. So let's sort of strain that down. What does that really mean in layman's terms? So since the beginning of the pandemic, the Fed has been buying up $40 billion per month in mortgage-backed securities. What were they trying to accomplish? Well, they wanted to keep interest rates low, and so they brought in this extra demand, this $40 billion per month of purchasing power to keep interest rates low to get the economy spurring. Well, as we've transitioned into 2021, as we've seen some inflation now, especially with supply chain issues, the question has arisen that do we really need to keep doing this? Do we really need to keep buying up mortgage-backed securities to the tune of $40 billion a month? And the answer now coming officially from the Fed is no, we really don't. We need to start tapering these purchases in a responsible way, meaning they're not just going to turn the spigot off, but they are going to start to identify a date where they're going to begin tapering, probably to the tune of about $5 billion a month. As we get into 2022. So it looks like now that language is leading us to believe it's going to be sometime around November or December. We're going to see the Fed start to pull back on its mortgage-backed security purchase program and start to scale back. So by the time we hit maybe middle of 2022, the Fed won't be a market participant at all. At least that is the plan. What does that mean? Well, that means we're pulling a major purchaser of mortgage-backed securities out of the market, and interest rates are going to rise. And that's kind of the intended effect. Rising interest rates means inflation will moderate, and we'll make sure we don't get into a situation where inflation goes out of control. And really, the Fed doesn't want to be a market participant. This is supposed to be an emergency stopgap measure. So the Fed wants to get out of being a market participant here. So that's what we're seeing. And really, what did that result in? Well, interest rates predictably went up a little bit. So a little bit meaning roughly an eighth of a point. Let me flip the screen around here. We'll take a look at mortgage-backed securities. Here they are. These are mortgage-backed securities, the financial instrument upon which fixed rates are based. Green days are good days. That means the securities trading up in value and the interest rates are going down. Red days, not so good. That means that the security is trading down and interest rates are going up. And you can see here's Wednesday. Here's the policy statement. Not a lot of volatility on Wednesday, but we got walloped yesterday. That's when everyone kind of digested the news, reset what their new normal was going to be. We saw traders selling off in some positions. The value of mortgage-backed securities declined, meaning the associated interest rate went up. Again, this equates to about an eighth of a point in rate, which is the smallest increment there is. And then down here we can see today, Friday, we're relatively no movement. The market's been relatively flat. So all this just means that the market is repositioning itself to not consider the Fed as an active participant, that the Fed is planning to begin tapering and the market is positioning itself as such. That's to be expected. Another factor in here is the COVID case count. And this is straight from the CDC website. And we can see that COVID cases, we knew they were rising in August. We knew as we got into Labor Day. And really everyone kind of expected that on the heels of the Labor Day weekend, when a lot of the country is out at the beach, a lot of the country is gathering, that we would see a spike in case counts. That was something where everyone really wanted to watch and see what would happen on the heels or coming after the Labor Day weekend. And we really have not seen that spike. Cases have continued to decline over the past week and a half. That's good news, certainly for the United States. That's good news for the globe. But that also gives further fuel to the fire that the Fed doesn't need to be too terribly concerned about leaving this purchase program in place long term. COVID cases are declining. We're seeing inflation pick up. That's an indication to the Fed, hey, it is time to begin tapering. So what does all this mean? Are we really headed for tapering? Well, the next 30 days are going to be critical. As we get here to the latter half of September and go through October into the beginning of November, pay attention to the data, not just the inflation data, but also jobs data, also the COVID case count, all of these things. If they continue on the track they're on now, it will definitely lead to the Fed tapering their mortgage-backed securities purchase program. If things reverse, we see joblessness skyrocket, or we see the COVID case count go up, or there's some new variant that gets discovered, then we could see the Fed stay in the purchase program longer. It'll be an interesting next 30 days, but all indications are interest rates are going to be headed incrementally higher. The Fed's going to be tapering their mortgage-backed security purchase program. But not to worry, interest rates are still at excellent levels. We're just about an eighth point off of where we were last week, so not a terrible increase. If I can be of any service to you, please don't hesitate to reach out. Mark.Milam at highlandmtg.com, 404-395-1102. Have a good weekend.